Thanks for tuning into this broadcast of Navigating Through Uncertainty, and there is uncertainty for sure. And somebody that I have great regards for, I'm bringing him right now in this conversation for the next 20 minutes to try and help us how he's thinking of the current situation. Kenneth Andrade on this situation, on this episode of Navigating Through Uncertainty. Kenneth, thanks so much for joining in. We were talking about this off air as well. Are people second guessing the impact of the virus, of the extent of the damage to business and otherwise, and thereby to what the equity markets could do in the near term?
So near term, I mean, they are second guessing, and it's happening because the experiences say so. So, I mean, if you hit the ground and you speak to a number of smaller businesses that are there is an inventory issue, and there is a payment cycle which is extending itself. And that's going to be a little expensive in the near term. So yes, practically there are challenges that are there in the system. I mean, it works this way: there's a small component of your machinery that comes in from China. Your entire working capital cycle is locked up just because of that small component. So I guess everyone's reacting to this, to the environment. So there are near-term challenges, and it will be a little expensive navigating through it. But I don't think it's going to be such a long. I mean, it's not going to be perpetual in nature.
Yeah, I agree. But I'm just trying to figure out, Kenneth. And since you started off with this business thing, let's go that, and then we'll probably move on to how you're looking at the globe. All the conversations that we had with companies in the month of February. Everybody suggested that we have inventory till March, early April, and then if the situation worsens, then we don't know. But the point is that while China might be limping back to normalcy, it is spreading at an alarming pace across the world, in the US as well. We've seen increased cases in China. Therefore, it's not a financial response that we can give to this, right? We don't quite know what the extent of damage would be. Would that be a fair assumption?
Yes. I mean, we definitely know what. We definitely don't know as to how this will emerge in the medium term. So today you have supply side issues, tomorrow you'll have demand side issues, because it's moved from the supplier to where the demand actually is. So none of us know as to how it will evolve itself. One thing that we need to take for granted is that it's going to be expensive navigating through this cycle, and we probably will not go back to the way business is done in the past.
But not perpetuity in the near term.
It's not perpetual. I hope it's not perpetual.
Yeah, but again, okay, you hope it is not perpetual. What's the second order effect of this, Kenneth? One is that companies will probably have to let go of some bit of demand if there is demand and they can't meet supply, and that is an imponderable. But I heard you mention that it's going to be expensive to navigate to this. This is because companies will have to arrange for alternate sources of back-end supplies, so on and so forth, or manpower issues, or a mixture of everything, including higher cost of credit as well in a falling interest rate environment. What is it?
One is payment cycle is going to get delayed. Your inventory cycle right now is high. It will get higher as you have to restock and make sure that these contingencies don't evolve. Your credit cycle has to come back to normal, and this has come at a time, especially for corporates in India, when the bottom end of corporate India has been struggling with higher working capital requirement and also struggling with higher interest rates. Okay, this has come at that particular juncture at time. So the timing of this probably is not perfect.
It isn't. And OPEC has done its bit to add to the volatility as well. How critical or important from a sentiment stroke other perspectives do you give? I mean, I know the larger argument is crude falling is great for India, and it is. But for businesses, for your set of companies or other companies that you look at or you talk to, how does this volatility matter?
It matters for the economy as a whole and for the global economy as a whole. So when you look at energy prices falling, energy prices is one of the largest parts of your entire P&L, your expenditure basket, and that has a deflationary impact on the cost of manufacturing. If the amount is passed on to you, okay, if the drop in crude prices is passed on to the end user, I think that is a question mark where it comes to economies which are struggling with their deficits. So crude prices are falling, which is good for a certain segment of the economy, a certain part of the economy. But if it's not passed through, I think corporates will not be able to pass on that incremental cost down to their end user.
Okay.
So it's a global shift in pricing. It's a global shift in pricing, and prices have to come down. So it's slightly deflationary in nature.
Okay, well, which maybe a few of the corporates won't complain about. But Kenneth, then the larger point is that markets, to my mind, would also be a factor of how confident is any investor, whether an institutional investor or a professional investor or an individual investor, how confident is that person about his assessment of what could happen next. With that confidence taking a bit of a dent right now, because it's looking difficult to predict what could happen next, would you reckon that money will continue moving towards safe haven until all of this subsides, and therefore is that net negative in a sharp way for risky assets including equities?
First, you have to define risk as to where the assets trade also. Okay. And then probably find your safe haven in those assets. Traditionally, every asset market is buy low and sell high, and once you've done that multiple number of times, we know essentially how returns will get generated over the long term. So today we are in an environment where risky assets, so-called risky assets, the flight of capital is from those risky assets to something else. So there is always a bubble getting created at the other end of the flight of capital, and that as soon as you identified that, that's where you come in. So this is an ongoing process. But to measure all of this, or probably put a number to all of this, everyone uses a certain quantitative factor called valuations. Okay. But purely from a numerical point, because we can say valuations are cheap, etc., but purely for a numerical point of view, if I look at the context of it, not just in India, but probably it's trending across the globe in equities. You've got indices coming back to 2007 highs or 2008 levels, and from the last 10 years, even the large cap indices would have returned a little over liquid fund returns or some such number. Small cap indices and the mid cap indices are already there. So I'm sure as an economy from the peak of 2007, we're a lot better. And I just put it up, and from a number point of view also, the peak number of companies that made losses were in 2017, okay, compared to where we are today. So a lot of that is already, my sense is, behind us, unless there is some unquantifiable event or a prolonged lockdown of global trade for a period of time. So that's how the environment is emerging. Now, whether risky assets are priced in, you probably have some way to go, maybe. But my sense is that you mostly there, and when there's so much noise on the street, usually these asset prices find their bottoms.
Okay, so you would sense, Kenneth, that because it's nearly impossible to time the bottom all the times, maybe a good strategy might be to stagger out your purchases if you want to, but try and find value, because as you mentioned, that a risky asset is risky at particular values, at certain valuations. The risky asset also becomes safe, and we might be in that zone right now for equities.
So you look at individual businesses and companies that are there. I think you go back to the granular level of looking at corporate India, and I'll shift the conversation there. So when you put down most of the commodity businesses, they're already trading at book or below book. When you put down most of the utilities, they're trading at book or below book. Okay, even when you come to the financial system, except for the 5 large banks, okay, and not even large, I mean, most of them are in the private sector, everything else is around book or below book. So you come to a situation where, I mean, define how you want valuation. The problem remains is why we are here is there is very little growth in the underlying recovery. Okay, and that is not a quantifiable or a predictable number. And there is a flight of capital to another extreme of the market, which is perceived to be growing or to be safe. So that's what essentially has happened. But from a balance sheet construct, we've come a very, very long way. at least on the asset side of India, manufacturing, commodities, etc., a lot of companies have gotten the act into place and have been cleaning up, except for this period of cleaning up has been extremely prolonged. The entire risk is transferred to the financial services or the lenders or the capital providers, and we're seeing that actually play out. And once we find a solution for that, I think what we essentially need is transmission of interest rates down to the end user. And
right.
once you have that, I think we'll start the cycle all over again. Now, timing the cycle is going to be next to, I won't say impossible, but it's near term, but whether it's a year, 2 years, we have no idea about that.
To somebody like me, Kenneth, when I look at this situation, it's the reason why I think it's a bit different, and every time we say this time it's different, but I'm just trying to get your sense out here that we have a situation wherein growth domestically is sharply contracting or has contracted. At least the headline numbers suggest that. We have money flowing out from all emerging assets, not just India, but all emerging markets as well into safe haven, looking at the coronavirus issues. We, in the past, whenever we had these issues, demonetization or IL&FS, etc., wherein we've seen some risk aversion, the global markets at least were a lot more stable.
Supportive.
This time around, it's not there, and therefore, could this be a bit prolonged? I know you mentioned at the start, and I'm asking this to you again, that it's almost nearly impossible to predict when it will turn. But a lot of people are penciling a Trump announcement or coordinated central bank action to turn this around. Do you think it could be as simple or not?
No, I don't think it'll move in any very orchestrated manner. Okay, and each economy is struggling with their different issues. If you go back to the liquidity crisis that you had in 2007 or 2008, it was the world's largest economy that went through the cycle. Here, the smaller economy is going through the cycle, and we all have to individually deal with it. Okay, it will hurt the largest economy, but they are also in an election year. So my sense is that it will behave very differently from where it has been in the past, and more or less it should take time to ease itself out rather than give you a very V-shaped recovery, a very V-shaped large recovery. Of course, that large recovery, or there could be a minor blip because you will always get a valuation bounce, and then you will separate the growth companies from the rest, and that's how it prolongs itself, and that's how it moves on.
Okay, so would you be, if you're getting fresh capital, or if you were sitting on cash, are you now in the throes of trying to deploy large oodles of it, or are you still staggering out your purchases?
I mean, firstly, there's very little capital which is available. If there's anything on the sidelines, it is now as good as tomorrow.
Okay. Okay, so if you get it, you would be happy to deploy it?
Yes,
fully.
No doubt about that part of it.
You are finding value within corporate?
Value has been there, at least in the space that we operate for the last 1.5 years. It's only accentuated itself right now, and that is because, like, we've been through this before. There's no growth in the underlying economy. So whether you price these companies at 12 times, 10 times, 8 times, 5 times, there is no answer to that. And for businesses which are got that element of growth and perceived to be safe, whether you price it between 30 times, 40 times, 50 times, there is no science to that either.
Okay. Okay, so Kenneth, then one last question really. I won't get down into what you like, what you don't like, because that's not a forum for that. I just wanted to ask you one last question. There's a legitimate argument 6 months ago for buying into value because the growth, or the ones which was depicting growth and liked by the markets, were just exorbitantly priced. By virtue of this correction, even that has come down. Do you reckon that when all of this stabilizes, the first large dollops of cash will move back to the companies which have shown the performance in the last 18 odd months, or because value, which was anyways valuable and has come down, as you in certain cases, as you said, will be just so egregiously priced on the downside that money might think that let's buy here because frankly the downside is just so restricted here?
I'm not going to predict where capital is going to go, but
it's likely, I mean, looking at cycles, etc.
So it's always businesses that have participated will get the initial amount of capital. Till that cycle, I won't say collapses, till that cycle eases itself out. So So that's normally what has happened. If you go back to when tech corrected in 2000, the first ones that came back was tech before they handed it over to everyone else. If you go back to the investment cycle, the first companies that actually bounced back were all the companies or large asset-based companies before the consumer part of the economy and the private sector financials took over. So that's historically how they've all behaved. My sense is it may not be very different this time, okay, but we don't know what's going to be on the other side of the decade. But it's definitely not going to be the same subset of companies, because on a 10-year cycle, or if you see every 10-year cycles, the participants, the leadership always changes.
Okay. Kenneth, really appreciate you taking the time out and speaking to us today on Navigating Through Uncertainty on Bloomberg Quint. Really appreciate your time.
Thank you, Neeraj.
Thank you. And viewers, thanks for tuning in to this very special conversation.